Good afternoon, and welcome to the second of our regularly planned FSRA sessions, where we are planning to brief all our community members and guests on certain developments that have been happening in our respective areas. Last week, we had a great overview by my colleague, Matt Campbell, who talked about capital markets and the new firms that we have seen. And he also provided some guidance on application processes and what we are looking for. Today, we have my colleague, Fraser Brown, who looks after the banking and insurance authorization. And hopefully we'll have an even better presentation and an overview. So if you can bring up the slide deck, please. Thank you very much. So, as I mentioned, we will be talking about our various sectors within the FSRA. So I'll spend a few minutes talking about this particular area from a market development perspective, giving an idea about the overview, the firms, the engagements that we are seeing. And then I'm going to hand it over to my colleague, Fraser Brown, who's going to talk about the regulatory update, the applications and the processes, forthcoming regulatory developments, and we'll have some time for Q&A. Next slide, please. Thank you. So the overview of the landscape, of course, it has, as usual, on pretty much every activity had a huge impact. We did have a significant increase 2 to 3 times in inquiries, and the applications are now starting to feed through to a fairly large application pipeline. It is getting quite interesting. Some fascinating models are being proposed. On the banking side, yes, of course, the banking industry is stressed, but resilient. I mean, you would have seen from the recent surveys that have come up is thanks to the macroeconomic stimulus that quite a lot of governments in and around the region, and indeed globally, they have done. It is quite resilient. As I mentioned, there is a significant amount of credit that is being passed into the market, and there is a digital transformation happening. Now, what we saw was that initially people paused for the moment because they wanted to understand what the impact of COVID would be. But now it has come in. I think people are becoming much more comfortable with the underlying shifts for the macroeconomic stresses and clarity on, of course, the vaccine and changes to the demand and supply structure. So we are starting to see that. And there is a strong interest in digital banking. And we all know that the long lead cycles. I mean, setting up a digital bank is not a trivial exercise. Besides this, and Fraser will talk more about that, we had an explosion of interest in payment services and exchange houses. And of course, we've also had existing firms here looking at how to upgrade and add more regulated activities within that. Finally, we are also seeing a steady growth in the insurance sector and activity within the captives and reinsurance sector. Next slide, please. So we've had quite a lot of market engagement. Recently, of course, Cybos was one of our big areas. So we spent quite a lot of time speaking to colleagues around the world. It was online. It's not the same thing. I think one of the best things about Cybos is that you do tend to meet up with old friends and find out how things are going, especially for people who've been working in the banking sector for a long time. But it was good. I think despite the challenges that webinars and web conferences place, it was good to pick it up. And thankfully, we saw the same kind of market developments as I echoed in the previous slide. From tomorrow, we have FinTech Abu Dhabi, and I would strongly encourage everybody to check out FinTech Abu Dhabi. A significant part of the conference, which is our flagship FinTech conference, is going to focus on elements that are related to banking and insurance, digital banking, payments, onboarding, et cetera, et cetera, et cetera. Very strong lineup, very strong FinTech pieces, very strong speakers, and quite a good engagement that we are seeing. So I do hope you can join us there. In terms of webinars, we did quite a lot in terms of the corporate debt restructuring. We talked about exports, we talked about cash flow management, supply chain resilience. On the private banking side, we talked about supporting Indian family offices, ADGM family offices and foundations. And we recently did a fascinating piece around sustainable transaction banking, and more of that later. We participated in several webinars with ADGM firms, and a significant amount of engagement has increased with our existing banking and insurance ADGM firms. One more thing that I'm sure you would have seen is that we are starting to make a steady and strong push into various sectors, because at the end of the day, you can't just talk about banking without talking about corporates being based over here and corporate treasurers, et cetera, et cetera. So we participated in a recent webinar run by one of the ADGM firms talking about healthcare. We've already done several pushes on oil and gas. Abu Dhabi is talking about agriculture, space, so on and so forth. So there's going to be quite a lot of this coming up further as well. Next slide, please. So what else is coming down over the next few months? We will be doing much more on sustainable transaction banking. As people know, that banks and corporates are starting to talk about being net zero. So that obviously extends to their financing as well. So based upon what we did in the previous webinar that I mentioned about sustainable transaction banking, I think we will be developing it further. The regular series of digital banking webinars will be engaged as well. The next one is coming up in January. Payment services as well. We will be discussing that more. Healthcare investments, there's one coming up in December. Reinsurance and captives, again, we will be discussing more in the next year. As you know, we have a consultation paper out there talking about electronic transactions. So we will be exploring how to commercialize that and take it to market. Private banking and wealth management is a constant, so we will be focusing much more on that. And as I mentioned, the corporate business on the sectoral side, engaging with our banks, as well as prospects to push for more of that business to be anchored over here will be coming. I already talked about FinTech Abu Dhabi. That's, of course, as I said, a very, very important thing, and I hope you folks can join that. In terms of market engagement, China, India, Germany, France, Switzerland, US, Israel, all these markets are areas where we are having a strong push. And we will be, if not on a webinar basis or conference basis, hopefully starting from next year, once COVID and vaccines allow, to start having roadshows as well. So that's just a very quick canter through what we have. Now let me hand it over to my colleague, Fraser Brown, for his briefing. Fraser, if you will, please.
Thank you, Bhaskar, and hello, everyone. As Bhaskar mentioned, I'm Fraser Brown. I head up the Banking and Insurance Authorization team at the Financial Services Regulatory Authority here at ADGM. Thank you so much for joining this second FSRA briefing session concentrating on authorization. Those of you who tuned in last week will have heard my counterpart, Matt Gamble, talk about the capital markets perspective. And I'm going to give today, over the next 40 minutes or so, the banking and insurance perspective. Next, please. So just looking at the agenda, I think we've skipped one slide, but never mind. I'm going to focus particularly on digital banking and money services, two areas of really key focus for us at the moment. And as Bhaskar alluded, areas we're seeing significant levels of interest coming through. And there is a certain amount of overlap between the two, with certain market proposals in the payment space, perhaps looking to gear up towards becoming a full digital bank in the fullness of time. I'm going to try to highlight in this talk just some of the things we care about as an authorization function when we're assessing proposals, regulatory business plans, and applications. I apologize, it's inevitable there's going to be some overlap with what Matt discussed last week, but I'll do my best to keep that to a minimum. And I suppose I should also say that any opinions I express are my own. Next, please. So in terms of the banking and insurance team's remit, we cover banks, insurers, insurance brokers, as the name might suggest, but also lenders and money services businesses. And we are starting to see an increasing interest in digital lending platforms. We have one proposal currently under consideration at the moment, and we're talking to a few others as well. In addition, anything that comes from a bank or an applicant whose owner is a bank will come to us, even though it might walk like a capital markets application and talk like a capital markets application, it'll come to us. And so our team also has a number of private banks, wealth managers, custodians, and arrangers and advisors under our purview. Next, please. So in terms of digital banks, like I say, a key area of focus for us. We issued our guidance and announced the regime for digital banks about 18 months ago now, and as Bhaskar alluded, we've had a significant amount of interest. We've just recently approved in principle our second digital bank. That's come from an existing financial institution, and we're in active discussions with 2 or 3 more as well. This second digital bank is quite interesting because it's highlighted the range of proposals that we're seeing. Our first example was very much focused on trade finance, but this one is more geared towards using digital channels in the hope of expanding regionally and further afield as well. We're also seeing that proposals often raise the question as to whether they're truly digital in their scope. Is it a truly digital proposition, or is there just a little bit of gloss on top of what is essentially a conventional bank? Quite often as well, the user experience can tend to dominate the thinking of proponents, and to the detriment necessarily of some of the practical considerations, such as where and how people's money will actually be held, which is quite an important aspect of any banking proposition. Of course, any such proposals, whether for conventional banks or digital banks, will need to be mindful of federal restrictions that are in place on us as a financial free zone. And it's usually very wise to seek legal advice to ensure that a proposal is not likely to breach one of those or more than one of those. And just to reiterate that those federal restrictions are in relation to UAE deposits and deposits in the UAE dirham, and dealing in the dirham as well. And our rules also prohibit retail lending other than to SME businesses. So we need to look as well at the retail versus corporate element, and recognise that the federal restrictions do place something of a practical restriction on retail banking propositions. And we recognise, of course, that many digital banking proposals are geared towards the retail market, but nevertheless we are seeing interest in areas such as SME lending, which is seen as being ripe for disruption, and obviously trade finance as well. Next, please. In terms of money services business, and again, as Bhaskar mentioned, we've seen a truly significant level of interest in this market sector. It's hardly surprising, really, given the UAE's demographic and the fact that it's one of the world's major remittance centres and payment centres as well. This level of interest prompted a review earlier this year by our policy team and the banking and insurance team as well, just trying to make sure that our regime is fit for purpose and reflective of the risks presented by entities in this sector. That culminated in a consultation paper that was released over the summer, and then flowing from that, our enhanced regime has come into force this month. That's set out in Schedule 1, Chapter 8 of the Financial Services and Markets Regulations, and also involves revisions to a number of rulebook areas, such as revised capital requirements, bringing in a variable capital requirement, revised conduct of business requirements, bringing in a dedicated chapter to payment services, recognizing that our existing rulebook was geared more towards investment business. Looking as well at revised client classification requirements and introducing the concept of relevant money, as opposed to client money, which again was geared more towards investment business. And also we've tweaked some of our AML requirements in our AML rulebook. Providing money services, and the enhanced regime tries to make this a little clearer, covers a fairly wide remit, quite a broad spectrum of activities, from what you might consider fairly vanilla currency exchange and remittance businesses, through to payment accounts and payment services that include things such as stored value, e-wallets, prepaid and debit cards, and tokenized payments and stablecoin as well. So we're trying to make these more explicit, and equally the rules and regulations and capital requirements around those more accurate in terms of the risk that we're trying to cover. Next, please. Oh, actually, you've already moved. Insurance has not been an area that we've seen a huge amount of interest before this year, but I think a hardening market is prompting a significant uptick in interest. We are likely to approve our third captive insurer any day now, approve in principle, and we are actively engaged with a fourth as well. And we're seeing interest from both potential insurers, reinsurers, and brokers. Captive insurance is a particular area of focus for us because it offers a good way for local commercial enterprises and large corporate entities to manage risk more accurately and effectively, to avoid paying increasing premiums in a hardening market, to access the market on the basis of a more level playing field. And also ADGM offers local entities the chance to re-domicile existing captives from centres such as the Cayman Islands or Guernsey closer to home, which makes practical sense as well. Next, please. So in terms of digital banking applications, what is it that we're really looking for? What do we want to see from an application? The more observant of you will have noticed that when we released our digital banking regime, it was fairly closely aligned to our existing rules and regulations with regard to deposit taking. And there's a very good reason for that, because a digital bank is still a bank at heart. It's still accepting deposits and lending money, that classic financial intermediation model. In fact, you could say it's a digital bank is just a conventional bank plus additional risks such as operational risk, cyber risk, and IT security as well. Underpinning any application is the regulatory business plan, and that really should set out a convincing rationale. And I'll come back to the regulatory business plan later on in terms of some of the key areas that we're particularly interested in. We provide a template for the regulatory business plan, and in my experience, that's unique in terms of regulators. I've worked for a few regulators now, and this is the first one that's provided such a template. I was a little bit skeptical coming in, if I'm honest, having had several years behind me in regulation, but I've got to say it works in terms of my experience. It really does make the process much more efficient, because it allows us to look at a business model, really understand it, and provide feedback on it, but also indicate where we think that the risk might sit outside our appetite at any given time. Essentially, a regulatory business plan needs to answer four main questions: who, what, why, how. So who is the applicant? What does it want to do? Why, and why does it believe it will be successful? And how will services be delivered and controlled? The RBP, like I say, is not just a chance for us to provide feedback on, as part of a general process towards getting something authorized. It allows us to indicate early on where it falls outside our risk appetite, and therefore dissuade an applicant perhaps from spending a considerable amount of time and resource on putting together an application, which is a considerable undertaking. Other key factors we're very, very interested in, obviously, are the owners, the controllers, who's behind the proposal. What's the legal structure going to be? Is it an existing entity that's hoping to branch in, or will it need to be an ADGM company in its own right, incorporated here in the centre? The right to branch in the ability to branch in is a privilege rather than a right, we always say. And we need to be confident that the home state regulator, in the case of a branch, is ready, willing, and able to take on the consolidated prudential supervision of the entity, because we give over that aspect to the home state regulator, and we concentrate instead on the conduct of business aspect. Startup banks are specifically precluded by our rules, but we can and do entertain exceptions. Our first digital bank was a startup. But there needs to be a convincing rationale and a demonstrable sort of tie to the UAE, if you like, a real reason for being here and establishing in the UAE. Next, please. Without the ability to rely on a parent bank, however, a startup bank or digital bank will need to buy in the financial, technical, and human resources that they might be able to rely on a parent or group institution to be able to provide. So that means they're going to need to go out and source a board and senior management. And we take a very holistic view as to the composition of both of those elements. There are certain mandatory functions that that must be in place at all times, such as the senior executive officer, whom we approve and who must be resident here in the UAE, and other key areas such as compliance, money laundering reporting officer, and a finance officer. There are other roles that we don't necessarily class as mandatory, but we'd probably expect to see in relation to a digital banking proposition or indeed any banking proposition, and that might include a chief technology officer, a chief risk officer, perhaps a head of banking, and other perhaps senior management roles that we'd expect to see come in as recognized functions. In terms of other key areas we need to consider, not least is funding and financial resources. A startup bank's founders need to be aware of what they're getting into, if you like. They need to understand that it's a long-term play. It's not necessarily something that they're going to be able to flip into an IPO and get out within 18 months. So we want to see that there is a level of commitment there, particularly since typically a startup bank might not generate revenue for quite some time and might not generate a profit for 3, 5, or even more years. Certain of the UK startup challenger banks are still struggling to make a profit many years after inception, just as an example. So in order to help us take a full view, if you like, of what the proposal is, a comprehensive ICAP and IRAP is essential. That's in terms of providing us an accurate assessment of the depositor base, lending scenarios, and the totality of the risks being run, whether those are credit risk, market risks, operational and liquidity risks. Crucially, is there going to be access to further funding if needed? Next, please. So in terms of money services applications, many of the considerations that we'll have with regard to a proposal are not dissimilar to a bank or indeed any sort of regulatory business plan. We need to understand what the rationale is. What's the business model? Is it going to be remittance only, or is it going to involve payments? Are those payments going to be proposals such as tokenized or stablecoin payments? What is the target customer, and what's the market you're aiming for? Is it retail or is it commercial? Where are those customers going to be located? What's the scale of the proposition? What are transaction volumes likely to be? This enables us to get a good idea of the relative risk of a proposition, and also whether the applicant has fully understood the market and the likelihood of its business model taking shape. One recent proposal we had, for example, talked about in terms of customer scale, no less than onboarding 4.5 million retail customers. Well, that's half the UAE population right there. So it's that sort of suggested to us that they probably hadn't really done their market research and hadn't really thought about the realism of the proposal that they were putting forward to us. So we need to be confident that the people behind the proposals understand again what they're getting into and why they want to be there, and how they're going to access the people, the customers that they want to access. We're aware, for example, of the Central Bank of the UAE's recent stored values facilities regulations, and we're considering the potential implications for our ADGM firms and applicants as well. We also want to be sure that the people behind such proposals understand the banking tie-ups and arrangements that they'll need to have for transactional accounts, settlement accounts, and perhaps relevant money accounts as well. Next, please. Another issue that's becoming increasingly clear to us in terms of money services, which is an area many people are trying to get into. Many come from the technological side of things. They're very good on the IT aspect, but they have little or no experience in or understanding of operating in a regulated financial services environment. So again, the front end might look fantastic in terms of the customer experience, but they haven't really thought through the back end and the back office requirements that they're going to need it to have in place, or issues such as conduct of business and AML. So here, an existing payments provider seeking to expand into this market might be at something of an advantage. The innovative solutions that are looking to move into this space, again, like a startup bank, might need to buy in the experience, and then what impact does that perhaps have on the viability of the proposal as a whole? The human element is one I'll keep raising because it's incredibly important, and so the proposers behind potential applications need to be able to cover a wide range of potential positions, not just having a bank, which again a board of directors, which again we'll want to see brings a holistic and broad range of experience to the table, but also key functions, key control and business functions as well. We'll consider outsourcing proposals around some of those key functions, but we really do prefer the compliance officer and MLRO to be in-house if at all possible. Funding is always a key area, again, a common element. Can the proposal, again, if it's a startup proposal, can it fund its burn rate? Where in the early days, it really is just money out all of the time. You're just spending money, be it on wages, be it on electricity, phone bills, all of that sort of thing. Until you start generating revenue, you're just spending money. Again, are systems and controls sufficiently robust? Does the IT infrastructure look convincing? Given the huge volume of interest we're seeing in money services, and I probably have 2 to 3 meetings on average a day with inquirers in this sector, we have to take a robust approach to proposals. It wouldn't be sustainable for us to license each and every proposal that comes our way. And again, this is where the draft regulatory business plan can be very helpful to us in enabling us to identify propositions that again fall outside of our risk appetite or are unlikely to, in our view, to be ultimately successful as a formal application. And we're probably saying that in around 25 to 30% of cases at the moment. And I'd expect that number probably to increase over the course of the next, over the coming period as more and more applications and inquiries come towards us. Next, please. One of the key questions I'm always asked is how long does the application process take? We always start off with an initial meeting, and while consultants can be incredibly helpful to an application, we do want to meet the people behind the application. And we want, because it's key for us to be able to form a judgment around those people's understanding. Do they get it? Do they understand what they're getting into in terms of operating in a regulated financial services environment? That initial meeting, if the potential applicant is keen to progress, we'll look at a draft regulatory business plan, and we'll aim to turn around our feedback on that within 2 weeks or so. If our feedback is positive, we'll look at a formal application supported by documents such as policies, procedures, supplementary applications depending on the activities to be that are looking to be conducted, and applications and notification forms for the individuals concerned. Where those documents aren't available, where the policies and procedures aren't available, or where the people haven't necessarily been identified as yet, we can still look at an application, but it just means that those policies and procedures, those people will need to come in during the in-principle approval stage, and so that's likely to make that period a little bit longer. But it's not uncommon at all for applicants not to have identified key staff at the time of application. And where that's the case, what we want to see though is a sort of role profile, if you like, in the application, sort of demonstrating that the applicant understands the kind of people they're looking for in terms of experience and qualifications. Our review and assessment of formal applications, the time that takes very much depends on the application itself. If it's a bank, that might spend 10 to 12 weeks or perhaps longer with us under review and due diligence before we take it to our in-principle, our authorization committee with a recommendation for in-principle approval for our CEO. If it's a lender without that deposit base behind it, so not a bank but providing credit, that might take 8 to 10 weeks. And our key kind of area of focus there is, without that sticky depositor base to rely upon, where's the funding coming from? So that's something that we'll want to be very clear upon in taking such a proposition forward. Money services applicants, around 8 weeks, depending on exactly what the proposition is within that broad spectrum of activities. A pure remitter and exchange proposition might take a little bit less. Something like a stable coin or tokenized payment proposition might take a little longer, but 8 weeks is a reasonable average. Arranger advisors linked to banks can expect to take about 4 weeks with us, unless there are particular issues around it. And I should hasten to add, these are approximations, and these are time spent with us under review, not talking about the elapse of time where we've asked some questions and we're waiting for the applicant to come back to us. Assuming that the committee and our CEO agrees with our recommendation for in-principle approval, then once that is confirmed to the applicant, the period through to eventual financial services permission can take quite a short period of time, or rather a lengthy period. Something like an arranger advisor, you could expect to perhaps satisfy your in-principle approval conditions within 3 months or even less. I've seen it done quicker. A digital bank, or indeed any sort of startup bank, at least 6 months, more than likely 12 months plus. There's an enormous amount to put in place in terms of the infrastructure, perhaps hiring people, embedding systems and controls, testing and implementing all of the IT infrastructure around a digital banking proposition. It's not something you do in an afternoon and go home whistling a happy tune. it takes a lot of time, and it takes a lot of focus as well. And we're keen not to leave applicants at this point in the process twisting in the wind. We'll want to see a project timeline, and we will check in very regularly, probably every month or so, just to make sure that the satisfaction of those in principle approval conditions are tracking well against that project timeline. Next, please. So in terms of some of the further matters to consider around some of the specifics of the application process. Looking at the draft regulatory business plan, we provide a template. It's in section 6 of our core application form, the JIRA. It asks a lot of questions, but our purpose there is to try to ask everything we think we're going to need to know, or the vast majority of what we think we're going to need to know up front, to try and minimize the iterative process that can characterize applications. Do make use of that regulatory business plan by providing comprehensive answers to the questions. It's there for you to utilize. And if you do, you should be well on the way to providing a really good submission, and one that really gives us a very clear understanding of the business model and the risks inherent in it. It also helps cement the proposal in the applicant's mind, so it offers a double advantage in that respect as well. And we want to see the regulatory business plan in draft form, supported by financial projections, supported by transaction flowcharts, and also an ownership breakdown. Again, incredibly important as to who owns the applicant, who's behind it, and what are perhaps any close links or connected companies in the overall structure. We operate in banking and insurance authorization. We try to operate a sort of one and done process towards draft regulatory business plans. So we'll look at one version, and we won't really entertain further drafts, except in particular circumstances. We have done it, we do continue to do it, but in the vast majority of cases, we like to say you have one chance to kind of convince us, if you like. That's not us just being difficult or bloody-minded. What we're trying to, the problem for us is if we look at multiple iterations of a draft regulatory business plan, providing feedback in every case, we almost begin writing the business plan ourselves. We're sort of therefore compromising our objectivity and our independence as a regulator. The regulatory business plan really is, as I said earlier, fundamental to the entire application. Everything from policies and procedures, projected customer numbers and market, financial projections and assumptions, all of those should be referable back to the regulatory business plan. It should all connect, it should all tie up. If the regulatory business plan isn't right, then the application isn't right and it's not going to succeed. Next, please. In terms of the financial projections, I say it in just about every presentation I've ever given. Applicants always underestimate costs and overestimate both the timing and the volume of revenue. I've never sat across a table from an applicant who wasn't confident of turning $1 in month 1. It virtually never happens unless there's an existing pipeline of business that's going to come from a parent entity or another group entity. It's going to take time to get established. It's going to take time to get your name out there as a new entity offering financial services. And revenue might not flow for a number of months. And as I said earlier, again, during that time, you're running costs each and every month. So you need to be able to fund that lag time, like I said again earlier. We usually say we want to see 6 months of such lag time so that you can fund that burn rate for at least 6 months. But in the case of a startup bank, we might want to see even more. Like I say, revenue might not start coming into a new bank for, until years, 2, 3, or even later. One of the things that we notice as well, and it's something that we'd like to see improve, financial projections often don't provide a calculation of the relevant capital requirement, whether that's the base capital requirement or the one of the other applicable capital requirements, risk capital or expenditure based. And they don't, and the financial projections don't track capital resources against that requirement month on month. And that's an area that can definitely be improved. In terms of capital, we wanted to see mostly tier 1 capital, and that's more often than not pure equity in the form of share capital. Regulatory capital is subject to various deductions and conditions. They're all set out in the Prudential rulebook. But again, as I've been sort of banging on, we need working capital. You need funding on top of all of that to ensure that as soon as you switch on the lights, you're not dipping into that regulatory capital buffer. Next, please. In terms of transaction flow charts, I'm often asked, what do we want to see? Well, we want to see a pictorial representation, a comprehensive representation, really, of who does what for who and when. Who are the stakeholders? When are they involved? At what stage of the transaction do they come into play? And throughout it all, we need to be able to follow the money. That's a key aspect. So when is client funds, when are they taken on board? How are they looked after? Where do they go through the, in terms of the various touch points? Next, please. Next, please. So in terms of some further thoughts as well, I think it's key that we need to, maybe, communicate our role, what we do as authorization a little bit better. We're not investors, and so we don't want to see a regulatory business plan that's effectively a pitch, saying, how great the proposal is going to be. What we want to see is a comprehensive regulatory business plan. Equally, we're not consultants. There are consultants out there, many of them on the line today. We cannot compromise our independent judgment as a regulator. Yes, we're happy to discuss proposals. We're happy to give a view, but we can't help construct a business model or perhaps steer a path through what constitutes regulated activity and what doesn't. We're tasked with ensuring applicants meet threshold conditions. Authorizations is a gatekeeper. It's not our job to ensure each and every applicant is ultimately authorized. It's actually our job to ensure they're not authorized unless and until they can demonstrate an ability to meet threshold conditions. I say as well, every time I do this, that consultants have an incredibly hard job. That's not just lip service. I really do feel that you're trying to satisfy two competing interests between your clients and the regulator. And so I do sympathize in that respect as well. Just some further thoughts in terms of the human element. Again, extraordinarily important. We take both an individual and a holistic view when it comes to the board, when it comes to the senior management proposition. Don't underestimate compliance as a function. I often hear applicants say, well, we're not going to be doing much business in the early stages. We're not going to need a full-time compliance officer. In fact, the compliance officer is probably going to be the busiest individual in the office during those early stages. And so having someone on board is very important. And compliance shouldn't be seen as just a cost center. I talked about some of those banking relationships that our firms need to be able to forge in the wider UAE state. Those banks are going to gain much more comfort if there's a robust internal control structure in place at the client from their perspective that they're looking to onboard. Recognize there's a shallow pool of talent here in the UAE to a certain extent, and the wider region, and so we're very alive to that, and we're happy to look at outsource proposals. But I do worry that the competition is driving down coverage, is driving down quotes, and that consultants are quoting fewer and fewer days per week, and I do fear that that's not sustainable in the long term. And so what we want to see is that the application is very clear about the capacity of the compliance officer or any outsourced function to provide sufficient coverage, and really drill down into what that coverage is going to be. Next, please. So that really is a very quick tour through some of the things we care about as an authorization function. Some of the key, elements that keep us awake at night. In terms of coming attractions, we're going to be issuing guidance revised guidance on digital banks, just enhancing the existing authorization guidance that's out there. We're very soon going to issue authorization guidance around money services. And again, as Matt Gamble mentioned last week, we're in the process of introducing a digitized platform to enable us to provide authorization, supervision, and enforcement functions, as the case may be. Authorization, that phase we're looking to roll out first quarter next year, and supervision and enforcement in the second quarter next year. We hope that will enhance your user experience, as consultants and potential applicants, and throughout our process of implementing this, we've been incredibly focused on the external user experience. So we do hope that comes through. So thank you for listening, and I'll probably hand back now to Bhaskar for a Q&A session.
Thank you very much, Fraser. That was absolutely amazing, quite content-rich, and a good canter through what is obviously a fairly complex financial landscape. So we have about 6 minutes for any questions. So let me start by asking one question that came through via LinkedIn, Fraser. Do you have any expectations on internal rate of return, and are there any thoughts around that you can share?
It's not really a key area that we look at, to be honest with you, Bhaskar. We're much more interested in the funding proposition as a whole, what the solidity of the depositor base, and the risks that are being run in terms of then lending those funds out. Okay. The capital requirements and all of the ratios are set out in our prudential rulebook, and I encourage everyone to take a look at those. They adhere to international standards, and they're fairly comprehensive, but I think reasonably clear as well.
Thank you, Fraser. Another question that has come up is, you were talking about it from the perspective that a digital bank is still a bank, but for many reasons, digital banks, they are a bit more difficult to evaluate because obviously the digital side of it. In your conversation with people who you have spoken to both as in applications as well as inquiries, from the digital side, what are the couple of things that you would again re-emphasize that people should look at it from the technology side or the digital side rather than the pure banking side?
Thanks, Bhaskar. I think it really is getting a handle on what is the digital element that you're hoping to provide. What's the customer experience, but also what's the control elements of that? How are you going to utilize digital channels, and what are those digital channels going to be? Are you going to build your own systems, or are you going to look to buy in existing systems? And there are many options available. Microsoft is one that is clearly very advanced in this particular area. So things like that are something that we're I think I'd emphasize need to be considered. It's fashionable perhaps to say we're going to have a digital bank, but really what does that mean? Think through exactly what's going to be delivered and how. How's the connectivity going to work? What partnerships do you need to form? Are they whether informal or more formal? Are you going to be relying on group systems and controls, or do you need to truly incorporate third parties? What's the security aspect to it all in terms of penetration and cyber risk? What sort of testing are you going to do once they're and at what stages during the implementation process? What's the project plan overall for that? And that's something that can take many months in terms of just embedding all of those systems and controls and making sure that everything connects and everything's secure. How are you going to hold customer data? What cloud facilities are you going to use? We allow for cloud storage, but how is that going to operate in practice? So I think some of those are the key aspects that I draw out in terms of any digital banking proposition.
Great, thank you for that. Maybe one question on payments, and as you mentioned, both you and I have been spending quite a lot of time with a significantly large number of inquiries that have come in. I think that you keep on mentioning whenever we talk to prospects is mind and management in terms of the prospects. What is going to be in ADGM? Could you shed a bit more light on what that particular term, mind and management in ADGM, means for you, please? Sure.
It really means that the control of the entity is based here. We're not a brass plate jurisdiction. We want to see that the entities that are based here in ADGM, physical presence, we want that to be a real presence in terms of people on the ground. We want to see that the control is exercised here. The senior executive officer's got to be based here in the country, and they've got to spend an appropriate amount of time overseeing the entity as a whole. That's their job. We want to make sure as well that key control functions and key business functions are based out of here, that the regulated activities are truly being done in and from ADGM. They're not being outsourced elsewhere, and there is and it's all kind of smoke and mirrors, if you like. Again, we want to see that the board of directors, and we want to see that there's a balance of executive and non-executive there. They need to maybe not meet every board meeting here in ADGM, but the majority of meetings should be held here. We want to see that people are properly overseeing what's being done in the entity and in and from ADGM.
Great. Thank you very much, Fraser. So I think we have now run out of time. Thank you very much, Fraser, and colleagues who helped us to set this up. Folks who actually joined in, thank you very much for your time. If you can paste your email address into the chat box, we will make sure you get it. Otherwise, if you have registered, we will be sending the PowerPoint presentations and a link to the recorded versions of both this as well as last week's presentation and webinar. Thank you very much, and the next one will happen in Q1 of next year. Thank you very much, and have a lovely rest of the week. Bye-bye.
Thank you, everyone. Thank you. Bye-bye.